we were gonna start with the selling of the depreciable assets, né? We managed to treat the selling of the inventories, both the parent and the subsidiary. Now we're going to treat the selling of the depreciable assets to the parent versus the selling of the depreciable assets by the subsidiary. And then, then from there it will be the selling of non-depreciable assets. Yeah.
So we add example 4, if I'm not mistaken.
Example 4 was the subsidiary selling inventory. That one was done. So we should go to example 5. Example 5 is where there's, okay, let's start from paragraph 7.5 actually. So on this paragraph 7.5, we say the property, plant and equipment held by companies in the group. So we eliminate any profit realized when the asset is belonging to one of the company in the group is sold to another company in the group. However, the company that purchased the asset is still providing for too much depreciation because the profit is included in the cost price of an asset in its books. We should write back this portion of the depreciation for consolidation purposes, and the unrealized profit on asset is realized either through the sale of an asset to an outsider or the use of an asset at the rate of depreciation. The following situation may arise where the asset is sold within the group. Parents sell non-depreciable asset to the subsidiary. Subsidiary sells non-depreciable asset to the parent. Parent sells depreciable asset to the subsidiary. Subsidiary sells depreciable asset to the parent. Note: unrealized profit and the losses have income tax implication, which that one will be done in the third level. So we've got example 5, where the parent is selling non-depreciable asset to the subsidiary. So I'm going to share my Excel. Then we've got example 5. The parent is selling non-depreciable asset to the subsidiary. Please write these things. Parent selling to subsidiary and also subsidiary selling to parent. I will require you to write this part. This part, ne?
Yes.
Yeah, please write it. And then from there we'll continue. Okay, then now let's see. We've got a situation where the parent is selling to subsidiary, selling the non-depreciable item. So those unrealized profit will be deducted on the face value of selling financial position. So it means if this guy didn't sell that property, so we're going to have an unrealized profit. So the unrealized profit will be deducted when we determine the statement of profit and loss. The same unrealized profit will affect the face value of the SPL, which is deducted. Then the unrealized profit will be eliminated in the journals. So we'll be doing the reversal of what happened in the prior year. Because in the prior year, you recognize the profit, but it was not sold, so it needs to be eliminated. So let's read paragraph 5. Example 5. We've got a D Limited, which is a subsidiary, and E Limited on the parent. Or we've got the statement of D Limited and subsidiary E Limited for the year ended 31 December 2009. The similar financial position as at 31 December 2009. Assets, D Limited, assets for E Limited. And then we've got the equities for both E Limited and D Limited. We've got statement of profit and loss. The profit before tax is 20,000, 80,000 each. Income tax expense, the profit for the year. Then we have the statement of changes in equity. Then we have additional information. They say D Limited, which is the D Limited Kinki parent, acquired its interest in E Limited on 1 January 2007, on which date E Limited retained earnings amount to 10,000. Consider the carry amount of the asset and the liabilities to be equal to the fair value thereof on the date of acquisition. And then on 1 January 2009, E Limited bought property with a carry amount of 40,000 from D Limited and made a profit of 10,000. So this profit of 10,000 will be unrealized profit on 1 January 2009. For the year ending 31 December 2009, it will be unrealized profit, which it will be deducted when we're doing the income statement and will be reversed when we're doing our journals. So they do the consolidations. So as usual, we're gonna start with our analysis. So in this case, we are dealing with a parent selling non-depreciable item to the subsidiary. So we're gonna start with analysis as common, the basis of doing consolidation, basis of doing consolidation. One, percentage. Two, analysis. Three, elimination. So sometimes it can be recording then after elimination. Or if something is not yet recorded, so it means you have to record first before you eliminate. Consolidations. So here we're gonna start with analysis. With the interest is 70% because he acquired he acquired 70, well 100% was issued. So we're gonna have the total at since non-controlling. So we have a share capital. The share capital of the subsidiary was how much? 100,000. 70, 30, and then we have a retained earnings. The retained earning on the date of acquisition was how much? They said we acquired him when the retained earnings was 10,000, right?
Yes, sir.
10,000, 7, 3. Then the consideration paid we have 110,783. Then the consideration paid he paid 110. Nice. So goodwill is 0. Then we're gonna have the since acquisition to the beginning of the current year because they acquired this thingy on 1 January 2007, but we are doing the financial year ending 2009. So we've got 2007 financial year, we've got 2008, the whole year, and then 2009. So we're gonna have since acquisition to the beginning of the current year. Acquisition. To beginning. Current year. So from the since acquisition, we must have a retained earning. The retained earnings to the beginning of the current year. Subsidiary was having retained earnings of how much on 1 January 2009? As per SCL, we have a retained earnings of how much? This one is the 16,000. We see it from the SCL, SCE. The retained earnings balance at the beginning of the year on the subsidiary.
Yes, sir, we do. Yes, it's 16,000 for
Yes.
ELTD.
So the 6,000 times 70% is how much? It give me 4.2.
Sorry, I'm lost. What is the 16,000?
That's what I was asking, and then no one is only Rebi responded.
Oh,
The
I was busy looking for it. Sorry.
The 16,000 is on the statement of changes in equity on page 28. Is 28 of the study guide, 139 of the PDF. If you can go to the statement of changes in equity, they say they have a 16,000. Yeah.
Yeah, ELTD.
Yeah,
Yes, I can see.
ELTD, only 16,000 balance at the beginning of the year. That is the one we use.
Okay.
So we say 16,000 minus 10,000. The one when we acquire is 6,000. 6,000 times 70%. Then it gives us the 4.2. Then 6,000 minus 4.2. That balancing figure will be 1,800. Then we're gonna have a profit. The profit realized by subsidiary at the end of the year is how much? On the same year from the SCE. How much did he have?
21,000, sir.
Rabi said 21,000. Ntabi said Tulani and then Siponye. Do you agree 21,000?
Yes.
Then 21,000 times 70%. 14,700.
14,700.
Yes. 14,700.
Then we've got 14,700. And the difference will be 6,300. Then we can conclude. We add whatever need to be added. So the sum will be this. And then this one you can close it off. Then here you add this. Then here you add the 33 and the rest. Sorry. We're still in the same page, right?
Yes, sir.
Yes, sir.
Okay, now we're gonna go to the elimination. So we have a share capital. We're gonna have a debit credit. These are the journals. So we eliminate share capital. It was credited, but now we're going to debit it because we are taking it off. The share capital of the subsidiary is written, it was 100,000. So on the debit, and then we're going to have a goodwill, which is nil, and retained earnings. Retained earnings, it was 10,000 on the date of acquisition. 10,000. And then we have a goodwill. Goodwill is B0. And then we have investment in is E limited, ne?
Yes, sir.
Which is 77,000. So the difference between 77,000 and 110,000 will be what? The non-controlling, which it will be this. Then we have 33, non-controlling. Then that was the elimination of share capital at acquisition. That will be the narration. Then we've got journal number 2, which it will be the recording of the retained earnings that happened. So this will be here, this retained earnings that happened since acquisition. So it will be affected by the also non-controlling. So the retained earnings will be deducted. And we say retained earnings versus it's getting reduced. Non-controlling. Of 1,800. 1,800. We are still fine. So this
Yes,
is
sir.
it will be non-controlling. It's non-controlling. Then we're gonna go to the non-controlling interest that came as a result of the profit happened for subsidiary. The one for subsidiary, it's gonna come here. So it will be the 6,300. Then we're gonna have on the debit, we have the non-controlling SCI. Non-controlling. And then on the credit side, we have a non-controlling SFP. Which will be the one of 6.3, 6300, and then here we also have 6300. Then when it transfer it further, it will be 6300. Then now remember we said GE as a parent sold an inventory, sold a carrying amount, a PPE item with a carrying amount of 40,000 to E Limited. And he sold it with a profit of 10,000. So there is a profit 10,000 realized by who? Who made the profit?
Is it not D?
Yes, D made the profit. So now we have to eliminate the profit that was got by D. So initially the profit goes on which side of the account? It goes on the credit side, right? Normally, right? Akir, profit and income. When I'm doing
profits and income.
When I'm doing my journal alone, the profits and income, right, which is go on the credit side of my ledger, right?
Yes, sir.
But because now I'm eliminate it, it's gonna go into the debit side. So now I'm gonna say profit from the sale of property. Profit on sale of property. And then what is it gonna reduce? It's gonna reduce the property itself. Property. So the profit that was realized by by D limited was how much?
It was 10,000.
10,000.
So we take it off here, 10,000, and then on the credit, 10,000. So this will be elimination of the unrealized profit, because this profit is sitting with the parent, because the parent didn't sell it to anyone yet. So we eliminate that profit here. Then the profit is gone.
Okay, yes. So if parents sell it to next person, then it won't affect our elimination.
So if suppose the parent sell that property to another person, so it means now the profit is realized. So if it's now realized, then you have to revert back here to that thing that I've shared before. Can you see this?
Yeah, I see.
So now it will become area. So it means in the next year, then you will show that, okay, we sold this to the, so now we're gonna say, okay, let me make it in this side. The parent sold in total subsidiary, then the parent made a profit. So if subsidiary, remember we sold to the subsidiary, so if subsidiary now sell it to another third party somewhere, and a subsidiary make a profit, now we're gonna say that profit in subsidiary, we take the 70% of it. Remember, subsidiary we own him with 70%. So subsidiaries, in the minute he sell that property to another person and he make a profit, we're gonna account that profit he did from the third party. Only the 70% of that profit is gonna come to us as an other income.
Oh, okay.
Yeah.
Thanks.
Sharp. So to add here, if the property got sold by subsidiary to another person outside, is important to mention outside the group. Therefore, for consolidation purposes, we will account 70% of that profit in our consolidation. Because remember, we subtract this. Now, when suppose he's selling it, we will say now we add the 10, we're gonna reverse this thing that we did because now it will be a realized profit. But since the realized profit, we don't account the whole amount of 10,000. We'll only account the 7,000 because it's now realized because the profit was sold to another person. So only the 7,000 is going to be a realized profit. Sharp.
Yeah, it makes sense.
Okay. So now we proceed further. We can do the consolidations, which will be bullet point number 4. 4. Prepare consolidation. So our consolidation, we're going to start with statement of profit and loss. Statement of profit. So mostly they won't ask you about where the parent and subsidiary are selling non-depreciable item. It's very rare. Mostly they ask about inventory and selling of depreciable items in most cases. Those are the one complex. So statement of profit and loss, we're going to start with the profit before tax. Profit before tax. So the one for parent is how much? Profit before tax are parent, the guy from the SPL. 20,000.
20,000.
Okay. So 20,000. You add it with the 1 year subsidiary. Okay. It's 80.
Yes, 30,000.
So we get
Yes,
50. And then income tax expense. Income tax expense. Subsidiary, parent.
6,000.
Plus the 1 year subsidiary, 9,000.
Yeah.
Then we have the profit before tax will be 85. Is it 85 or 25? Oh, sorry. We didn't remember we must also take out the profit here. The 1 year unrealized, the one we eliminated, which the profit was realized by the parent. So you must also minus the 10,000 here. So we remain with 40. We still happy, ne?
Yes, sir.
And then we have profit before tax, income tax expense, then net profit. Net profit. For the year. Then we have other comprehensive income if we have any. Comprehensive income. I didn't see anything about to do with the revaluation, so it means it's 0. And then we have a total comprehensive income for the year. For the year, which it will still remain as 25,000. Then we close it. Now we must account those attributable. Table to owner of parent and non-controlling. The profit we realize for non-controlling is how much? Is this one, the 6.3. You remember the one which came as a result of the profit, subsidiary alone. So we're gonna say 6.3 So the difference between 25,000 and 6.3, how much?
$18,700.
Any question up to so far? None. Then we have statement of change in equity. So statement of change in equity for the year ended. When I have share capital, we have retained earnings. We have total. We have the non-controlling. Then we have total again. Balance it, boy. So the balance at the beginning of the year for share capital, for subsidiary, for parent, remember now we eliminated everything. We have 200,000, eh?
Yes.
Yeah, it's 200,000.
And then the one for retained earnings after the elimination. Now you're gonna say the balance of subsidiary, the balance of the parent, it was sitting as how much? 15,000, eh? Why one from the SCE alone, yet delimited. Do you see it?
From where?
The balance of parent from statement of change in equity from the SCE is 15,000. Can you see that 15,000?
Yes.
Okay. So now we're gonna say the 15,000 we add with profit realized by subsidiary. The profit realized by subsidiary for the year is how much? Remember, subsidiary ubilele this. Do you remember this? From the retained earnings.
Yeah.
Because subsidiary will retain earnings as 6,000, but out of the 6,000, we as the parent we own the 70% of that 6,000. So it means we are entitled to the 4,200. So the 4,200 will come the balance at the beginning. Yarena as the parent. It makes sense.
Yeah, it makes sense.
Other people, do they understand except Unto, except
Yes, sir.
Utulani? Ntabi saying
Yes.
Tulani is okay, Rabi is okay, Seponye?
Yeah, I'm okay.
All right. Then we say we add the 2, then they will give us 19,200. Ne? Then we add the 2, this plus this, they give us 219. So the non-controlling part, yeah, that profit at the beginning, it was sitting as 1,800. You remember, ne?
Yes, sir.
So which it will be anything that happened from the until when you add the 2, they will give you 34,800. So you're gonna say whatever happened at acquisition plus what happened now, which when you add the 2, they will give you the 34,800. So you take that 34,800, you plug it here. Then the total will be this plus this, which it will be equal this plus this, then 254. Then we have a profit that happened during the year. So we're going to take it from our consolidated SPL. How much was the profit? Answers right in your face.
It's 18,700, sir.
18,700. Then the one for non-control will be 6.3.
Yes.
Then we have the balances at the end of the year. Anything that you didn't understand up to so far? Anyone who have a question? So I'm gonna run fast. I'm not gonna do the balance sheet because the balance sheet will be the combination of whatever is happening here plus the asset item and the liabilities. So I'm not gonna do it. So I want us to jump. I want us to jump to the situation where now the subsidiary is selling non-depreciable item to parent.
Oh.
Now we have a subsidiary. Selling non-depreciable item to parent. So that one will be found in another example. I think the example 6. Subsidiary sell non-depreciable assets to parent. The following present the operating statement of Q and R Limited for the year ended 31 December 2009. Similar financial position, asset and equity. And then we have statements of changes in of profit and loss, profit before tax 2030, income tax expense, and then profit for the year. Then we have the statement change in equity, and then we have the information. Q Limited acquired interest in R Limited on 1 January 2007, on which date R Limited retained in amount to 10,000, considering the carry amount of assets and the liabilities of R Limited be equal to the fair value thereof on the date of acquisition. On 1 January 2008, Q Limited, which is the parent, bought property with a carry amount of 40,000 from R, and they made a profit of 10,000. So now it's the same information that we studied before, but now we accounted as it was now the profit realized by the subsidiary. Now we're going to have the basis method of answering. We've got the percentage, we've got the analysis, we've got the elimination, and then we've got the consolidation. So the percentage, they acquired how much? They acquired 70 of 100 shares issued, so it's still 70%. So our analysis, it will be as follows. Tau, it's not going to change that much. So it's at non-control.
Let's say which example are you on?
Well, example 6.
Example 6. Okay.
Share capital. The share capital that for subsidiary is 100,000. Eh? How much was the retained earnings at the date of acquisition?
$16,000.
16,000. Where do you get the 16,000?
I was looking at the statement of changes in equity.
Okay. That was the balance at the beginning of the year.
Yes, I can see. Sorry.
So we want the retained earnings at the date of acquisition, when we were acquiring the assets, when the Q Limited was acquiring R, as per adjustment
It's
number 1.
It's 10,000.
Yes, 10,000.
Then consideration paid is how much? As per investment, the investment amount from the statement of abridged financial position, they paid how much when they were investing?
77,000.
Agree, in order to get this, you will say 77 divided by 0.7. 77,000 divided by Wow. So here's the formula. In order to get this, you say 77,000 divided by 70% to give you 110. Then here we still have 83. Then we can go to since acquisition to the beginning of the current. Because I agree we don't have a goodwill.
Yes, we don't have a goodwill. Is it
Since acquisition to the beginning of current year, then we have from date we acquired him until now, we had the retained earnings on the subsidiary. It was how much? The retained earnings on the subsidiary from the statement of change in equity, how much?
It's 16,000, sir.
Then we're gonna less what?
10,000.
Then we left with 6. And then the percentage of 4%, I mean 70% of 6,000. $4.2. The remaining balance.
It's 1.8.
Okay. There is something that is going on which I don't know why they do that. That doesn't make sense. It's just errata. You can just see it's errata. Okay. Now here. Okay. Let's read the information on that. On 1 January 2008, Q Limited bought property with a carry amount of 40,000 from the R Limited and made a profit of 10,000. So we have a retained earnings, yeah, subsidiary as 16,000. That was the balance at the beginning. Okay, I want to do it smaller than a timeline again. 101 1 20 2007 was the acquisition date, ne? And the retained earnings was how much? 10,000. We are happy, ne? And then on 101 2018, I mean 2008, sorry. We've got a profit that was realized by the subsidiary for 10,000. That's a profit. And then we are told that when he closed the books on 31/12/2008, he had a accumulated profit of 16,000, meaning he made a profit of 6,000. So the 10,000 was eliminated on the date of acquisition. So this one was eliminated. Then we are left with this. So it means the balance, it will be 16,000. Then we say the 16,000 minus the 10,000 for elimination equal 6,000. Then okay, then we had the unrealized profit. Profit of 10,000. Which must now, because it's unrealized, it's not gonna make part of our when we do the consolidation part, it's not gonna be taken into account because it's an unrealized, it's not yet realized. It's only gonna be taken into account when it's realized. Therefore, sum So now it's accumulated loss. Do you see how I calculate this accumulated loss? Hmm?
Yes,
Because
sir.
here we have a retained earnings, which it was the 16,000 as the balance here, which the balance came as a result of 10,000 plus 6,000. The balance at the beginning of the current year of 2008 plus the profit realized at the end of 2008, which is 6,000. When you add the two, they give you 16,000. So on the 16,000, now you have to minus the 10,000, yeah, acquisition date. Now you're gonna remain with 6,000. Out of the 6,000, you have to less the unrealized profit, because the unrealized profit is not yet realized, so it must be taken out. Then it means our accumulated loss here, it will be minus 4,000. So here we also have to less the 10,000 year profit. So here we're gonna have minus 4,000. It makes sense. Rebi said yes. Ponye Tabisen Tulani. All right, means we can proceed then. So the loss of 4,000 at 70% is 2.8. And then the difference will be 1.2. So that was the retained earnings. Now we're gonna have the profit for the year.
So can I ask you something before you proceed? The unrealized profit is from non-depreciated asset.
Yes, the parent is selling non-depreciable asset.
Oh, okay.
I agree. If it was a depreciable asset, then it means now we're gonna have the take depreciation into account, something like that.
Yeah.
Yeah. So this
Okay.
was a non-depreciable asset.
Okay.
So now we have the profit for the year for subsidiary. How much profit did you have? You made a profit of how much during the year? Subsidiary alone. $21,000, ne?
Yes, sir. 21,000.
Then we can conclude. Okay, since acquisition to the beginning of the current year, I said is Okay, this part is not there. Then we have then we can do the journals. The elimination journals. We eliminate the share capital. The retained earning. Is 0. And then investment that he made. He purchased him for 77. So the remaining will be the non-controlling. Then the retained earnings, it made a loss. So initially, if it was a profit, we're gonna debit it, but since it's a loss, we're gonna debit non-controlling. Of 1.2. So we're gonna record this now, the 6.3. It will be non-controlling. And also non-controlling this side. The SFP and the SCI. It will be SCI. This one will be the SFP. Then the profit that was realized by the subsidiary. Subsidiary made a profit, which must be deducted or must be eliminated, and which affect the retained earning. And then we say property. The property is sitting in the books of Q, while the profit is realized by R. 10,000. 10, 1, 2, 3. Any question up to so far?
No question.
No, sir.
Okay, then it means we can do the statement of profit and loss. So more on the statement of profit and loss, will have profit before tax. The profit before tax of subsidiary of the parent is how much? 20,000, eh? The one year, parent is 20,000, subsidiary is 30,000. So
Yes,
more
sir.
you're not gonna take this 10,000 out, because the 10,000 was realized at the beginning. It was the profit happened in the year 2008, last year. You get it? So it means it was deducted in the 2008 financial year. It makes sense.
Oh, okay. Yeah,
That's
it
why
makes sense.
that's why you're not gonna deduct it again here. You're not gonna say minus 10,000 here, because it was deducted in the 2008 financial year. Now we are dealing with 2009, so it's already taken out. Ne? It's important to note the dates so that don't cram or I. Since there's a profit realized by a subsidiary or a parent, I'm gonna deduct it here. You must also check the profit was realized by that subsidiary or parent when, on which year, and which financial year are you doing. So here we're gonna just remain with 50. And then the income tax expense. It will be 6 plus, which is 15. Then we have a profit for the year of 35.
40.
And then we have other comprehensive income. Of nil. Then total profit or total comprehensive income.
$35,000.
Then we share it according to the attributable. Attributable to owners, parent, non-controlling. For non-controlling, we have a profit of how much as per our analysis? Gosh, 6.3.
Yes, 6.3.
We are still happy up to so far, right? So as the same, then from there, we're gonna go to the statement change in equity. On the statement of change in equity, it will be the share capital, we have the retained earnings, we have non-controlling, we have oh sorry, let me add the column here total here. total non-controlling total again. So the balance at boy the share capital it was 200,000 because others were eliminated. The retained earnings, it will be the 1 year parent and the subsidiary part. So now on the parent part, remember the subsidiary somehow we got eliminated. On the parent part, the retained earnings that we're gonna recognize, it will be whatever by a parent, then we take this into account because it's a loss. So we'll say parent here the retained earnings of how much? 15,000, eh?
Yes, 15,000.
Then we minus the 2,800 loss from subsidiary, because remember on the subsidiary we have to take the 70%. So subsidiary made a loss on the retained earnings of 2.8 because of the acquisition plus the unrealized profit that need to be deducted. So you minus the 2,800, then we left with 12,200. Then we add the 2. And then the non-controlling, it will be the 1 in it will be this one, the total in. And so okay, it's not the total. We have the 33, so we also have to take into account the loss that he incurred. So it will be, so this one I can say is this, while this one will be this part, which we had the 33,000. So we say the 33,000, we less the loss here 1.2. This one. Hold on. Okay, then we say 33 minus 1.2 should give us 31.8. Then we add this plus this. Then we're gonna have a profit for the year. So the profit for the year gonna come from the profit here in China, the one we did here, statement of profit and loss, which we got how much? We got this. So here it will be the 28,700. On the non-control, it will be the 6.3. Any question?
No, sir.
Then that's the end of our example 6. The situation where the parent and the subsidiary they are selling non-depreciable items. So now we're going to have a situation whereby the parent and the subsidiary they are selling the depreciables. Now I want you to write this. Please write. You will tell me where you don't, and then I will scroll down further. So here on this side is the parent selling depreciable assets to the subsidiary.
Sir, should we write the calculations as well?
Sorry?
The example analysis of example.
This one, you refer to this part?
Yes, sir.
Yeah, you can write it if you feel comfortable because it's going to go hand in hand with this information, the one of 5,000 something. So I'm going to just give you the notes, the treatment. I think you can do it on your study guide following my notes because now we are almost on 14:30. We're no longer having time for continuation with these two examples, but I can give you the notes for the treatment of the two methods where the assets are sold by subsidiary, where the assets are sold by the parent, and they are both depreciables. Then when you're doing the examples on your side, you can follow my treatment of the notes, and then where you don't understand, then you raise a question, which it will be in the form of WhatsApp. While we are writing, then I would like you to have attention to tell me, since your module will be written on, your exam is on what, 24 October?
Yes.
Yes, sir.
So since the exam is on the 24 October, and we want to have a 3-hour class before you write the exam, suggestion with Catherine is suggestion with Catherine was to have the class on during the week of I'll tell you now.
So are you gonna share the notes on WhatsApp, or are you gonna show it now, like the way
What?
we're doing it now? Those notes.
The notes, I'm not gonna share them. Instead, I want. Remember now I'm having this is the notes for how do you treat this for the parent selling to subsidiary. Then I'm gonna share another note for subsidiary selling to the parent now here, and then you take the notes, you do those examples, the two examples. You will say, someone will say, where about what?
No, sir.
I think it was not you, Rabi. Someone said something. Where are you with writing? Because I'm scrolling. Are you fine here, or you want me to scroll down further?
Just scroll down a little bit.
Okay. Is it fine now?
Yeah, it's fine.
So now I want to share the notes for parent selling to subsidiary. Create a subject selling to digital assets. Okay, this one was for this one was for parent. The one I gave it was for parent. Now I'm gonna give you the subsidiary selling. So this one is subsidiary selling depreciable item. Can you see it? Can you? Ponye, Ntabize?
Yes.
Yes, sir.
Okay, now you can write this one, the subsidiary selling to the parent. The previous was the parent selling to subsidiary. So on the other side, try when you will be studying, just do the studying learning number 7, you do learning number 8, number 9, and number 10. So that on that day, when the exam, the class will be 3 hours, you just try to ask more of the questions than doing the whole exercise. So you jot down your question that you'll be having, then we tackle them according to either it's coming from the study guide or it's coming from the tutorial letter. But we'll be tackling the question based on the way you ask them. I know there's too much work that need to be done in this next 2 weeks to 3 weeks. Bonya, are you in the group?
Yes, sir.
Okay, so more information will be shared, in the group. If there's anything that needs to be done. Okay, is there anything that you want to ask before we close off?